Markets remain weak on inflation concerns and how they may impact Q3 earnings. Tech underperformance continues as yields stay high, and commodities keep flying as the energy crunch spreads to oil markets. All this and more in this week's Macro Insight. And welcome to Macro Insight. Welcome to any new subscribers, any free trialers. Today is the 5th of October, and let's take a look at these markets. So last week, obviously a bit turbulent last week and even yesterday, right? So seems like the markets found itself a little bit of a local bottom right now. Let's see if that holds today at around 42.70. So what spooked the markets? We had a spike in yields, which trashed the tech sector. Nasdaq's down, not far from 10% from its all-time highs by the lows yesterday. But we are seeing a bit of a bounce, a bit of a reversal. I think it's not really conclusive just yet. So, higher yields, and we got, bearish evidence of higher inflation from a higher PCE, last week. And you also had, corporate profits looking like they were being impacted. So GM sales were down about a third, Bed Bath and Beyond stock was down 30% after they cut their forecasts. And, the market is starting to get into the idea that Q3 earnings guidance is going to be pretty poor across a number of sectors, as we're seeing these supply chain issues really hitting companies' costs. Yeah, so, seeing these supply chain issues really kind of starting to hit companies. And then on top of that, you also got wage pressures, right? Which is good. So margins are potentially taking a hit, and Q3 earnings guidance and earnings numbers are getting revised down, basically, right? Or expectations are getting revised down. And then you also had Powell admitting that inflation's proving to be more persistent than he would like. As you're seeing this European, not just European now, right? But this energy crunch that started off in Europe, because of the natural gas market going global, right? And you've to the point where China are urging power saving measures in like major cities, right? So these are things that feel like they're not about to disappear anytime soon, and going into what could be a colder winter period, these things could become even more acute, right? So that's really starting to kind of spook the market a little bit. And then the last thing really was the squabbling in Washington, right? So continued squabbling on this infrastructure spending bill that's yet to get through as the debt ceiling deadline approaches. The Democrats were squabbling amongst themselves. Now they're blaming it on the Republicans again, and it's just more and more political gridlock, which is, Biden's even said there's a non-zero probability. He can't guarantee that the US won't default. Now, that is something that most market participants really don't expect. But it's something that actually, if you look at market prices, some risk is starting to get priced in, okay? And where can we see that? So if we look at, there's a proxy for that, US debt ceiling anxiety proxy. So it's just the yields on T-bills, on really short dated US Treasury debt, basically, right? So you've seen that spike, a good 10 basis points in short order, which is a pretty big deal, right? So people basically dumping those because they're worried that those are not going to actually get paid, basically, right? There's, and that's something that is a bit unheard of for the US, but is starting to potentially get priced. It's just something to be aware of. And then the last thing on that front is, all this political posturing. Well, you've got Jay Powell as Fed chair that may need to get sacrificed, right? So are they, there's some commentators saying that is is Jay Powell's kind of lead at the Fed being questioned here and going to be used as a bargaining tool, because you've had the recent controversy with Kaplan, Rosengren, and now even Clarida, and the type of trading activity they've been doing with inside information. That's making the Fed look pretty bad, right? So you've got Elizabeth Warren really coming after Powell on this. And that's something, that needs to be watched, and how the market might react to the idea that Powell's kind of gone, right? Or doesn't sort of run the Fed, starting early next year. If we look at the betting odds on that, that's moved quite significantly, right? So something that, no one really thought possible. Okay, so these are the stats on Predict It, right? So these are like the betting odds basically of whether Powell's going to be the next Fed chair or not. And, he was sitting there well above 80, 90% or whatever a month ago. And that recently has tanked, right, after these scandals have come out, basically, right? So he's at around 68% now, which, is quite low, really, if you think about it, right? So it's definitely something that the market is starting to price. That may not be a done deal. Okay. And then the final sort of cloud or sort of negative thing in the news again is China Evergrande. So obviously, that's back in the headlines. They missed another bond payment, and their stock was suspended from trading. Right now, there was some good news in that they're kind of selling a stake in their property management business, which arguably going to raise them about $5 billion, which would kind of help with their liquidity issues that maybe allow them to pay a few coupons here and there. But, and Beijing has kind of said that they're going to limit the fallout. They're going to prop up the healthy developers in the property sector, homeowners, and the real estate market as a whole. They're going to be there as a bit of a backstop at the expense of global bondholders. So they're not bothered about bailing out global bondholders, but they're going to try and ring fence this rather than bail out Evergrande and everyone who owns Evergrande debt. They're just going to try and ring fence it. Let the global bondholders suffer, but try and protect, parts of the domestic economy, basically. So that seems to be how they're going to manage this situation, right? Now, the market has kind of then responded to think that's not going to lead to global contagion, right? So people who own Evergrande debt are going to get screwed, but that's not necessarily going to lead to global contagion for the entire credit market and that sort of thing, right? The type of Lehman's moment that some people had feared, yeah? So those are the things that have been kind of making the market nervous and creating this kind of bearish price action. So let's have a little look at the charts. So here's the S&P chart. We've had a decent kind of move down over, where did it start? Kind of started early September. And on the technical level, there were some big levels, right? So this 4270, 4275 was a big level of kind of Fibonacci confluence. And that seems to be doing its best to hold, okay? So that's encouraging. You've got some bullish divergence popping up as well. So you've got this momentum indicator. When we made that first low on that, let's call it an A wave correction down here, momentum was very weak. We then got a B wave bounce. We've got a C wave completion of the correction, providing it is complete. And on that recent low that we made, momentum hasn't made new lows. That's called a bullish divergence. That's often a sign of a bit of a buy the dip opportunity, basically, that the correction is complete. Okay, so technicals are kind of spelling some positive signs. We do, however, have this gap. If we break 4270, then arguably the kind of next major area of support is around this 4130, 4140 area that also coincides with the 200-day moving average, which a lot of people will be eyeballing, basically, right? So before that, there's not really going to be much to stop this market if that level breaks. So that is in play at the moment. I wouldn't say we've rallied quite enough. We've bounced about 50 points off that level today, that's where we're trading. But, this week is going to be key to see if that level really does hold, okay? But so bear in mind that is a possible outcome, right? That we can go as low as there. Yeah. Down there, I would expect the first test of that level to certainly give us a bounce. But if we manage to break that level, then, it means there's a lot of more bad narrative out there that's kind of driving things lower. Okay. So that's where we saw the S&P. Now, another encouraging sign, apart from just the momentum divergences, is the VIX. So we bring up the VIX chart. We can see that we're starting to see lower highs in the VIX, okay? So we got that initial move up to sort of 29 odd on the VIX when Evergrande first kind of came out, the Evergrande news. Not that people haven't known about Evergrande for like years, but still, market got spooked that week before the FOMC. Then we got a vol collapse. And now you see again, these vol spikes that we're getting are coming in a bit lower and a bit lower, basically, right? So that's another form of divergence that we're seeing as the market, S&P, makes lower levels. The vol spikes don't seem to be as aggressive, okay? Now, some of that sort of price action in vol has to be down to the big JP Morgan put spread collar trade that everyone's talking about on Twitter. And, you know, everyone's kind of aware who looks at this stuff. Every quarter, there's a big JP Morgan asset management fund that is long the market, and they do put spread collars to protect that long position. And that's just a systematic trade they do. And they use the quarterly expiries, right? So the end of March, June, September, and December expiries. So we had that trade rolling off last week, and they rolled it to December. And whenever they roll this trade, it supplies the market with a chunk of volatility, right? Because it's a net Vega sale, and it gives the street a load of volatility, and the street anticipates that flow because it's so predictable and it's so systematic. So knowing that that chunk of Vega was coming to the street, and then that trade happening last Thursday provided the street with the Vega that it needed. So even though markets were looking and feeling weak, they didn't necessarily need to bid up the vol to the same extent that they might have done had that flow not been in the market, basically, right? So that's something you need to be aware of that can impact volatility markets. But you know, even though it's flow driven, the fact that the market has that vol on board now means that it makes it a little bit less stressed an environment, and there's less need for the market to really puke because people have been given a load of vol exposure, basically, right? The dealers have, okay? Now, we had been selling spikes in the VIX, so we'd managed to get some shorts on, as subscribers will know from my top trades. We'd sold into that initial spike. We'd benefited from that reset post FOMC. We'd covered most of our VIX shorts there, and we started reselling again at around 23 in the October VIX future. As the S&P started to test that key level of 42.70, though, I did put in a stop on my VIX at 24.5. Have not been stopped out on that short yet. So we're still trading back at around 22.5. But I'm going to be pretty disciplined with that stop, because I do think if we break that 42.70 level, then there's potential for VIX to go back towards those sort of high 20 levels again. And I want to be in a position to be able to sell that strength as and when I'm ready to get bullish again, basically, right? So just kind of, if you're selling VIX or short VIX, be very aware that if the S&P breaks 42.70, we're probably going to get some sort of acceleration and some sort of VIX spike. Yeah. Now, on that note, you know, Spot Gamma, the guys obviously that I follow and some of you follow, are suggesting the street is pretty short Gamma still around here. Until we get back above 4,400 on the S&P, that position isn't materially changing. So above 4,400 in the S&P, you're going to see a big move back down in vol. You're going to probably see realized fall off a cliff. And so bear that in mind. Below, around here, 4,300 and below for now, expect quite a bit of choppiness, right? And we're seeing that in the price action. We're seeing 50 to 100 point intraday moves in S&P, which, you know, typically we haven't seen for a while, but we are seeing them pretty consistently. It's because the street's kind of grappling with the fact that it doesn't really have a lot of gamma on board. And so that's going to keep things in a state of sort of flux at the moment. Okay. So the VIX here, we've got 22.25 in the front, 23.40. I mean, that's already a 1.2 steepness of a curve, right? So normally when vols are in the 20s, you get a flat to inverted term structure. And that's when that calendar trade where you buy the back and short the front can make sense, because it's a more defensive way of playing the short vol trade. Basically, you're saying when the vol goes back down, the curve's going to go upward sloping again. I'm going to make my money. If I'm wrong and the vol keeps going up, I'm not just naked short, basically, right? So that's the reason to do a calendar rather than just smashing out the front month VIX, which is obviously a more risky trade. I would say that for this level of vol, the curve is actually too steep, upward sloping. So actually the value of being long that calendar where you buy November and short October is not there. The value is not really there, because you might see the entire curve shift down and that steepness actually stay at about 1.5 vols. So you're not going to make a lot of money in that trade. So I actually don't think that trade's as attractive as it often is when the vol has a spike, basically, right? So not a trade I'm a massive fan of right here, right now. If you look at the realized vol though, you got 10-day, you're kind of ignoring 10-day because this is a 1 month metric, right? So 20-day and 30-day realized 12.5 and 14, which is a pretty big gap to where the current VIX is, right, at 22. And the reason why, there's a couple of reasons why we have that gap. We have that gap because, people have been buying vol, right, and for protection, and we've had this move down. But also, so skew has been relatively elevated. So as we've moved down in spot, implieds have ridden up that steep skew. But you've also got the fact that intraday vol is high. So even though the close to close vol on a 20-day basis might only be 14, if you look at the ATR, which is the average true range, it reflects the intraday range plus the overnight gaps. That's about 1.3% on a daily average, looking at past 14 days. That would equate to a 21 vol, which is much more in line with where the VIX is trading. So the idea is, if you're a gamma trader, if you're a vol trader, you're getting enough intraday volatility to actually make back your time decay. So you don't need to dump all of your vol right now. And the reason why that's happening is because the street is short gamma. If we get back above 4,400, the street positioning is a bit more comfortable. Intraday vol is going to collapse, and you're going to see the VIX collapse with it to be much more in line with the close to close realized vol, which might actually even go sub 10 if that happens, basically, right? So there's definitely a risk there. There's definitely a bit of a premium here because of the intraday choppiness. But like I say, if we can get our head above 4,400, there's going to be a major move down in vol. And that's something to be aware of if you're trying to play upside sort of trades, basically. And we'll talk a bit about the type of upside trades that can take advantage of the expensive vol in a minute, basically. Okay. What else am I seeing? Despite the broader market weakness that we've seen and the stagflation concerns that are being blamed for it, the sector leadership that we're seeing is suggesting that something else might be going on. Okay, so, or we might be heading in to a slightly different sort of dynamic, right? So if I look at this chart here, this is the sector moves from last week. You've got, energy, the big winner, up 3.5%. You've got metals and mining small up, utilities small up, but you've got retail and tech and healthcare getting trashed, basically, right? So you're definitely getting more of a cyclical leadership coming from the market. And that might be signaling what, some of the other macro guys like 42 Macro and Hedgeye are saying, which is a mini reflation trade coming into the end of the year. Why might we see a mini reflation trade? Because the rate of change of growth is going to bounce. So we had a slowing of growth, okay? We had, obviously, the Delta variant go through all over the place. And so the reopening had a bit of a stall. But now, if you look at the numbers on COVID cases, etc., they've clearly peaked. And so the cyclical parts are now starting to show some leadership, right? And, Merck just dropped the news last week of their new antiviral pills, which are like slashing hospitalizations again. So that gave a boost to travel stocks. Airlines were up 5%, things like that. So if we do get this high frequency bounce in growth and the rate of change ticks up, and we get a bit of a travel and leisure bounce as well on the reopening idea that Delta has passed us, Delta variant has passed, or COVID in general, which is going to be less of a problem as we get these drugs that we can now use, then that's where you might get fuel for a bit of a cyclical bounce into, say, Thanksgiving, basically, on that rate of change. Okay, so that's what a few macro guys are going for. And you're not going to see a big bounce in the S&P unless tech stocks stabilize, right? Because the FANGs account for 25% of the S&P, and what the tech stocks do is going to depend on yields. But if we can get a stabilization in yields and we don't just start ripping higher in yields and taking techs down lower, then there is sort of room for a bit of a bounce into, say, the next couple of months, into sort of mid-November, which is around Thanksgiving, basically. Okay. Now, JP Morgan's Kolonovich, I think is how you pronounce it, right? He's a quant strat. He kind of agrees with that narrative. He thinks it's a buy the dip kind of opportunity. He's expecting energy prices to keep going higher, driving an equity market rotation. He thinks the reopening reflation trade, that's outperformed over the last week is going to continue as COVID cases are down 10% week on week. And then, so basically he's not, and he doesn't think the China stress is going to be allowed to turn into a systemic problem, basically, right? So he's very much thinking this is a buy the dip opportunity. On the flip side of that, you do have some bearish analysts out there, like the guy Mike Wilson at Morgan Stanley. So he's warning that, in his latest update, he's saying that Q3 earnings are going to potentially be a problem, right? So supply chain issues are posing a material risk to Q3. Companies are going to struggle to beat EPS estimates at the same rate that they have for like the last 5 quarters. So those are his major issues. Beyond that, he sees earning risks are coming from inability for companies to pass on pricing, as they have laid out in recent weeks, margin risk related to higher wages that people are demanding, basically. It seems, and Juliette de Klerk was talking about this, that companies are struggling to hire because people are waiting it out and saying, we're not going to come back to this job unless you pay us a lot more for it. So, the money from the government, basically, and the easy money that maybe some people have made through trading stocks has afforded them the luxury to be able to wait for higher wages, basically, right? And that's going to put pressure on company margins, okay? And then finally, the reversion to trend in goods consumption. You had a lot of goods consumption brought forward through lockdowns and things like that. A move back towards mean is going to mean consumer demand drops off a bit, basically, right? So these are all things that he's citing as problems. I kind of agree with him on a lot of those fronts, but I just think that might be problems we get in Q1, Q2 next year. But in the super short term, I think there's fuel for a bounce, basically. Okay. Now the buy the dip retail guys don't seem to have come in yet, or if they have come in, they're offside. Okay. But obviously a lot of those guys like the tech space, and the tech space has seen some rotation out of it, basically, right? So, the ARK ETF, for example, has been getting slammed as yields have been going higher. A lot of those are like the favorite names, right, for the retail buy the dip crowd. Okay. But, whilst markets have been weak recently, my sense is that positioning has lightened up a lot. Okay. So sentiment is way off the highs, if not pretty bearish right now. Volatility momentum, as I've said, is waning. So you're not seeing the spikes involved to the same extent as you had been seeing on weaker price action. Okay. Growth data is ticking up at the margin. So I would be inclined to play a bit of a bullish trade right now in the short term, in line with what some of these macro guys some of these quant macro guys that look at the rate of change data that they're looking for, basically. And we are starting to see signaling, like we said, from those cyclical parts of the economy to kind of confirm that trade could be on, basically. Okay. And you have got some underpinning things like corporate buybacks still there, ample liquidity from the Fed. Even though tapering is there and it's on the table, tapering is still only tapering. That doesn't mean they're not buying, right? They're still buying bonds. That money finds a home into the markets, okay? And it's still in the billions or tens of billions, right? So I would say, put a stab on that type of trade does make sense, but be cognizant that if you start buying the dip here, we may get one final sort of burst lower towards that 41.40 area if this level at 42.70 breaks. So you want to be in a position to add to your bullish bets down there rather than being stopped out of them, right? So those are the sort of ways I would think about it. Then if we look at commodities. So this chart kind of summarizes pretty much what's been going on in all the major commodities since the start of September. So obviously you've had blowout performance in nat gas, uranium, nat gas up 40, uranium up 20. Obviously uranium was up close to 40 at one point, but had that big correction, but it's starting to tick up again. Oil's doing pretty well, consistently kind of charging higher. Carbon credits obviously have been on fire as well. Corn, like grains, are sort of a bit of a nothing done really in the last month. And then you've got copper, gold, and silver underperforming, right? So for me, I'm kind of trying to stick to the winners in commodities. I don't really want, like, I like copper longer term. I've got an allocation to copper. I'm certainly not getting out of it, but I'm not adding tactically on the recent weakness in copper because I don't really want the exposure to China property, right? I think the Chinese property market is still going to be under a bit of pressure, even if China manages this situation. So you're going to get the kind of bearish headlines out of that, and that may well keep a lid on copper short term. Gold and silver are just trading horribly. No reason to really touch them, especially if you believe in the reflation trade in the next 6 weeks. That's probably going to take real yields higher. That's going to be a headwind for gold and silver. Staying away from those commodities right now. Commodities that I like are oil and uranium. Again, subscribers will know they're both in my top trades. I bought that dip in uranium recently as a tactical. Obviously, I've got long-term exposure to uranium as well, which I'm doing nothing with. And oil, again, I've also been long, as you guys know. Keeping those for now. Oil price action looks really good. Recently, it's basically on OPEC yesterday, it had a spike 2-3%. It's taken out the July highs. Price action is very strong. The market was potentially looking for an increase in production beyond what was expected, which was 400K per month, given that a fuel substitution's going on now with the energy crunch that's going on in gas, coal, etc., power, etc. So we didn't get any increase in production beyond what was expected. And so you see that spike in oil, basically, right? That's kind of been the reason for that. So now that very much opens up the way for a move to potentially, where are we? So for me, that opens up the move to potentially 85 to 90 area, like by year end. I'm not saying it's going to happen overnight, but that break here above those July highs is very bullish technically, right? We may get we're on the top of this sort of very short-term channel, so we may get a little bit of mean reversion here, but I think breaking above, that 77 area was pretty key. And I'm pretty comfortable with my long right now in oil. I had taken a little bit of profit earlier on, but I'm comfortable with the long that I've got on the remainder, basically, right? Now, so outside of that, nat gas, I've got a few things to say on nat gas because that have been hitting the press recently. So obviously you had this energy crisis going on, right? That kicked off, and the reason was that there's been a lack of capex since the since the 2010s, and now that's kind of hitting the market, right, in this kind of shortage of supply. And the exports from Russia haven't been what we've needed. You've had a bit of cold temperatures, over last winter, etc. And you've also had droughts that have been affecting the hydroelectric power generation, basically, right? So you had a multitude of factors that have created this power shortage, okay? But on top of that, you've had some market-specific factors as well, right? So you've had this nat gas trade where you've got European natural gas and you've got US natural gas. And traders in that market have been doing an arb trade where they've seen a massive spike in European natural gas relative to US. And so if you look at that trade and how it's performed, the range, that there's been an arb there. Any time, and you look at the left-hand chart here, right? So anytime the European gas market has gone to a premium over the last, going back to 2008, it's been a pretty safe trade to sell that and buy the US. And you had that mean reversion, basically, right? When that price differential has got to, certain levels. Now, this time round, it broke and it just went parabolic, basically, right? So it's blown up a bunch of traders in the natural gas market, and margin calls have kicked in, and it's just created havoc, basically, right? So that has definitely exacerbated the recent spike we've seen in nat gas, that this spread has just kind of blown to smithereens, okay? Now, that's also created a massive spike in implied vol, which is the right chart, in nat gas. So 3-month implied vol has gone to 108, right? Which is highest level ever for nat gas vol. And people might be tempted to sell that vol spike because, as you know, vol spikes tend to generally come back down. They have a gravity to them. That's what happened in this kind of rogue wave that we saw in 2018. It got slammed straight back down. I would just warn people who want to play the short vol side of that trade in nat gas that this is not like trading S&P vol or the VIX, right? The VIX has got a gravity to it that is tried and tested, and it comes from the structural nature of the VIX market and the S&P vol market, right? People own equities. You've got the Fed that's there. Their reaction function cares about what US stocks do. You've got a lot of factors that are bringing back vol sellers to the table in equity markets, right? The problem with these commodity markets, when they do this type of thing, is they're happening because of structural, fundamental supply-demand imbalances, basically, right? They'll be addressed at some point, I'm sure, but it's impossible to catch the timing on that, basically, right? So I would be very wary of selling too much volatility in this vol spike in nat gas, because it really ain't the same as selling equity vol. And I just want people to be very careful and very aware of that. Yeah. Now, a trade that we had mentioned last week that might make sense, is not one that I've done, it's not one I've really even priced, but a trade that might make sense is to sell put spreads in natural gas as a way of collecting some premium in what is probably a very, very expensive put spread, given volatility and skew levels, basically, right? So I suspect, just like meme stocks, that's a trade that has worked in meme stocks. It may be a trade that works in nat gas, but outside of selling a put spread, relatively tight put spread, quite far out of the money, I wouldn't be touching this with a barge pole. Yeah, so that's my personal view. After 20 years of trading vol, I'm not rushing into that market at all. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.